All right, we should be live. Hello, everybody. Good afternoon, and welcome to our weekly webinars hosted by Hendricks Wealth and Estate Management. Thank you guys for taking your time out of your busy work days, maybe your lunch hours, to join us today. Joined with me on screen is Jim Madel, Jim Hendricks, and Daniel Leitner, our advisors on our staff. And I am Tom Anderson. I'm one of our newest advisors on staff. Um, Today, I wanted to get on here and share some things that you can do in your 20s and 30s that can help set you up for success long term. So the title of my webinar today is Money Moves to Make in Your 20s and 30s. So the first thing I wanted to start with is why starting young matters. Starting early does matter, and if you look at this, time is the biggest financial asset that you have. Time is great to have in life, but it's just as good to have with financial success. Starting early is a huge thing. Compounding interest favors people who start early. And just as an example of this, I wanted to go over if you wanted just $1 million by the age 65, how much it would take for you to invest each month to get there. If you start at age 25, assuming average S&P return rates, you have to save just about $110 a month to reach that million by age 65. To reach that same million at 35 is $345. So if you're still in your late 20s, early 30s, you still have time. You always have time, but that 345 is not crazy. But by age 45, if you want to save $1 million by 65, that same $109 a month at 25 jumps to $1,157 a month. And that is the power of compounding interest, money, earning money over time. But regardless, whatever you can afford to invest now is going to help that number lower over time, even if it's not the full 109 or $345. It's going to help lower that rate that you have to save later on in life. And the biggest thing is just small steps now always will beat bigger steps later for you long term. All right. Another thing I wanted to touch on is the free money first. This is one of the most important things you can do is never leave free money on the table. In life, you're not going to find a lot of free money. There's not many opportunities in life where money comes free or even cheap. But one of the only 100% guaranteed returns in this world is the employer 401k match. So with a 401k, an employer can match your salary. Oftentimes it's 3%, depends on the employer, it can be different. But let's say you have a $60,000 salary. If your employer matches just 3%, that's $1,800 a year in free money that you get free. You don't have to pay tax on any of that kind of stuff. And before you know it, if you have a $60,000 salary, you're contributing 3%, your employer's contributing 3%. That's $300 a month really fast that we just looked at the last example. That $300 a month can get you a lot closer to those retirement goals. And after you capture that 100% guaranteed free money from your employer's 401k, another not particularly free, but this is a tax-free option, is a Roth IRA. For you as a younger person, you have a long time to grow your money. So this is one of the best tools to do that. A Roth IRA, you can put taxed money in now. So you're taxed at a lower rate now. So you're going to be paying your taxes on the contributions to your Roth IRA now. But by the time they grow into those larger numbers that you can have at retirement, they're not going to be taxed when you take them out. So that long-term growth that we're talking about can play a huge part in helping save for retirement. And once you're there, limiting what you're getting taxed on. So if we're looking at things that we can start pouring our money to as people in our 20s and 30s, always take that 401k match no matter what. Do not leave free money on the table. And if you have money to put towards a Roth, that's a great, fantastic tool. And any extra investing that you can make, you cannot go wrong with investing in your future, whether that be a discretionary account if you're saving for a down payment on a house, or if that's a different kind of retirement account, potentially IRAs or whatever that may end up being. So the next slide is making debt work for you. And a good thing to think about is not all debt is created equal. There can be good debt and there can be bad debt, depending on your rates. One thing that we can look at is student loans and mortgages. If those are low rates, oftentimes we recommend sometimes not paying those off if they're in the 4, 5, 6% range, because if you can have these kind of loans and this money, oftentimes it's not only manageable, it can actually be strategic. It can help you build credit, and it can help you potentially even earn more money if you're investing the extra money instead of trying to race to pay down these rates. On the flip side of that, there's some bad debt, and what I would even say some really bad debt, and that's things like credit cards, payday loans, things of that nature, where you're getting these crazy high 20, 30% interest rates on things that can often lead you down to spending more money. A credit card, I have a $2,000 limit on my credit card, so does that mean I have $2,000 for money that I can just spend myself? Not when you're getting taxed 20, 30%, or charged 20, 30% extra on top of what you're spending, just an interest alone that you're giving to these big corporations, these billion-dollar corporations. So these 20% credit card loans, these payday loans, even if they seem appealing, can just be horribly toxic and set you back years on your potential goals in life. Another big trap to avoid is this recently, popularized thing of buy now, pay laters, the Klarnas of the world. The promise that, okay, I want this $1,300 75-inch TV so my friends can come and watch football on it and see how cool I am for having this big TV. There's a couple reasons it can be a trap. You see that it's 0% interest for 12 months. Okay, well, I can pay $110 a month and pay off this TV. That seems easy. It's only $110 a month. Until you start realizing that, one, you could be buying things that you can't afford or you shouldn't be buying. And also, they have some hidden traps where if you miss a payment or if you're a month late, they're going to retroactively charge you 20, 30% interest on the entire purchase. And it can cripple you when you're thinking that it's a free money that they're just letting you take your time on paying off. So if we have these bad debts, one of the biggest things that you should be prioritizing before anything else is getting these paid off, because they're going to be setting you back faster than anything else. It's like a negative return pretty much on your money. So you could look at a couple different ways to do this. Two popular ones is the snowball method. The snowball method is where you start with your smallest debts. So let's say you have a $500 city loan payment, $1,000 in your Discover card, and $3,000 on whatever. Start by tackling that small one first so you can knock off these small debts. And this could build motivation because, oh, I only have to knock out a $500 payment. That's pretty doable. I can do that in a couple months. And now I only have two balances. And then you knock down one. I only have one balance left. That's not too bad. So that's one way a lot of people like to tackle it. And it just helps you build motivation to get those higher limit ones down. Another popular method is the avalanche method. This is where you're paying off the highest interest debt first. And financially, this could make the most sense, but it's sometimes a little harder to get started and keep yourself motivated if I have a $6,000 balance on my city card. So I'm going to try to pay that down because it's charging me 30%. But with $6,000, sometimes it's hard to know where to start. It feels overwhelming, and you can end up just kind of throwing your hands up. So depending on your personality and what values you have, either one of these can be great. And getting rid of that bad debt is one of the most important things you can do, especially while you're still young. Um, that's a great thing. Uh, and starting to invest early, we've kind of already touched on this, but one of the biggest things is saving money in a bank. That is important, especially for emergencies. But when you want to actually build wealth long term, you're going to have to start investing for growth. Um, and you need to invest. A good way that we recommend generally doing this, and where we put a lot of our funds into, are broad market index funds, ETFs. It's a simple, low cost way where you can get exposure to hundreds of different companies all at once. This is really important when we start talking about diversification. Being in our 20s and 30s, we have a lot of friends who can come and tell us, hey, I just doubled my money last year because I invested in Nvidia and I have the next stock that's going to do the same. Trust me, put your whole money into this. Well, when you do that, you open yourself up for a lot of different risks. Um, Risk that it could go down to zero if the company decides to go nose down, or you can lose a good portion of it. Um, so we need to not shoot so much for the short-term wins. As fun as hearing 100% return might be, using these funds and getting diversified is the greatest way to set yourself up for success. Another way to do this is to automate your contributions. If you set money aside every single month, the same day, you can make this automated, set it and forget it, kind of like a bill coming out of your account. Let's say it's 50, 100, whatever you decide to invest, every month that comes out of your account, money that you're not even thinking of. Um, and so this is just a way that you're never going to skip like investing your money that month. And one of the biggest things that we as financial advisors would like to stress is trying to avoid timing the market. One of the like a key example of this is if you missed the 10 best market days in the last 20 years, your returns would have been over half of your returns if you just were in it the entire time. Um, Timing the market's impossible. Some down days have the next biggest day the day after. So just the key is to stay consistent, let time do the heavy lifting, and remember that time in the market always beats timing the market. And while we're building all this wealth, an important thing is to start protecting it. Health insurance often is given to you by employers, or you have an opportunity to purchase it through your employer. It's one of the most important things to preventing medical debt. Medical bills, these are the number one cause of bankruptcy in the entire US. So having a good health coverage is definitely critical in protecting what you're building, because if you find yourself down hundreds of thousands of dollars in medical debt from some kind of emergency, that could cripple you and bankrupt you as well. Um, and life insurance is also something that's often overlooked, especially for younger people, when really this is the most important time to have life insurance. Term life insurance, that is, it's the cheapest while you're young, it's the cheapest while you're healthy. And we recommend this, especially if someone or multiple people in your family are reliant on your income. If not, if you're a single person, then it maybe doesn't apply to you as much. But if there's people in your immediate circle that rely on your income, having a term life insurance plan can be beneficial to keep your nest egg safe. Um, and one more thing is just keeping beneficiaries updated on all your insurance policies, that life insurance, and on any of your accounts, so that money doesn't get caught up in courts or go to somewhere where you do not intend it to go. And one more thing about budgeting now. Budgeting is not about cutting everything fun out in your life. I would never tell anybody to stop getting that Starbucks coffee in the morning. That's not going to set you up for retirement by skipping one coffee cup or skipping going out with your friends on the weekend. But it's just about aligning yourself into a positive framework for success. And now some of us might not be at this point yet where we can do this 50-30-20 framework, which is where you put 50% of your money towards needs like groceries, housing, and bills, 30% towards wants, those Starbucks coffees, the going out with your friends, and then 20% into savings. you might not be at the point where you can put 20% in savings yet, and that's fine. This is more a goal to shoot for, especially long term when you get to a point where you can start doing this. A rule of thumb that we kind of see a lot is this thing called lifestyle creep. It's when you get a raise. So I get a $10,000 raise, and now my spending is going to go up $10,000 because I have $10,000 more a year to spend. We shouldn't really be doing that. Try to capture some of that money and start raising it towards your investments or saving for your future. That's how you can start building wealth without feeling deprived. If you get a $2 raise, maybe put one for spending and one for your savings, and that could be a good way to start setting yourself up long term. Um, this is a way that you can still enjoy life now and start building for the future. The other thing we recommend is having an emergency fund of some kind, whether this is in a cash account or in a discretionary account, just generally between 3 and 6 months of expenses. So if you find yourself in a job market search where we all know the job market right now is difficult to find a job right away. So having a 3 to 6 month safety net for you can be a good thing if you are able to have it at some point. So what do we talk about? These things aren't necessarily overly complicated, but when you take it together, it can create a really solid foundation for you. So building that safety net, not having that toxic debt can help you to start investing in your future, especially when you can get things for free, like those 401ks and that tax-free growth of the Roth IRA. Getting the debt paid off, investing early, compounding it, protecting your money, and spend it with intention instead of spending it when you have the dollar. And it's not all about perfection, it's just about consistency. If you can start focusing on one of these things or even two of these things or more a year, you'll be ahead of a lot of people your age already. So think about which one of these steps that you feel confident in, which ones you're struggling with, and remember, we can help with that. We can help build a roadmap, personalized roadmap for your situation. And if you ever want to connect for a quick conversation after this webinar, building wealth is not something that you have to figure out alone. And all of us are here to help guide you with that as well. And so that brings us to the end of my presentation here. If we have any questions in the chat, there's a Q&A section in the bottom of the webinar. If you have any questions, type them in there, and me or one of these other guys will be happy to help on that. And if you see on the screen, this website link here, www.hendrickswealth.com, has a list of each one of our weekly webinars coming up. We do these every single week at the same time during your lunch hour. Hopefully, you can get on there, register for some more, and here's our contact information. If you want to request any appointments and our number for any questions you might have, we're always available. But for
Perfect.
you said,
Yeah, and while we're waiting for any questions to come in, as Tom said, at the bottom of the screen there's a Q&A button for you to submit any questions you may have. But some of the upcoming webinars we do have is next week on October 22nd. Jim Hendricks will be joining PADS, which is a not-for-profit organization, and we'll be talking about legacy giving, leaving a lasting impact. The week after that, I'll be hosting a webinar with Facing Common Financial Fears, a calm approach to investing. And then the week after that, on November 5th, we'll have Dan Leitner doing No Need to Rush Paying Off Your Mortgage, which is a little bit on what Tom touched the tip of the iceberg on here today. So you can visit our website and go to the events tab and register for future webinars.
all right, it looks like we have one question came in. Let's see. It says, I make $50,000 a year. I have $20,000 in student loans, and I have not started saving yet. Where do I start? That's a great question. Getting started often can be the hardest part. If available to you is a 401k plan, that's a great spot to start, especially just coming out of school. depending on your student loan interest rate, um, you might not have to rush to pay that down. Just be making your payments and then potentially look into a 401k plan. And if it's not offered through your work, you can always look into IRAs and start putting a little bit of money aside towards that if you have extra money at the end of the month. Let's see. I'll answer. Okay. We'll wait on a couple more minutes, see if there's any more questions. But thank you for that question. That was a great question.
All right, I think we can wrap up for today's presentation. And thank you, Tom, for putting this together for us. We really appreciate it. And for all of you that are watching, please feel free again to go on to hendrickswealth.com and go to the events tab and sign up for future webinars. We look forward to seeing you.
Absolutely. Thank you guys very much. Have a great rest of your day.
Bye bye.
See you.